So, um, part B is exactly same, although now we are dealing with interest. And remember, interest, what is interest? Interest is the cost of money. It's depends on time. Okay, the time cost of money. Um, so the more time passes, the more interest you have to pay, right? Um, so here now you have a loan note. It says a 900,000 note payable that requires 12% annual interest or $9,000 to be paid at the 20th day of each month. So you pay $9,000 on the 20th of each month. 20th every month you pay that amount, right? So let's say your interest was paid on April 20th, right? Because it's 20th you pay. Now, now the question is, and your next payment is on May 20th. So what's the adjusting entry you're gonna do for the month of April when it comes to interest? So on April 20th, sorry, April 30th, right? That's where you have to do an adjusting entry because there is an expense called interest expense that you have incurred during this time that belongs to the month of April. Okay, why? Because the time, so the last time you made a payment was April 20th. From April 20th to April 30th, 10 days have passed. Those 10 days of time, the cost of the money in terms of time you have incurred, which is called interest expense during the month of April. So and that belongs to the April and not May. So you have to do an entry. It's called an adjusting entry for interest expense. So guess what? That means you're gonna be booking something called an interest expense. Okay, so my handwriting is getting bad. I'll try to fix it. Interest expense, you're gonna be booking that interest expense for $3,000, right? Because it says, and even in the question, as of April 30th, 3,000 of interest expense has accrued, right? That's it already gives you that amount because this is what you have incurred. You're gonna accrue that amount. This is an amount that you must take into consideration during the month of April. Right on the last day, you're gonna book an entry and call it interest expense debit. Okay, and you will, because you're not paying cash till the next month, you will create something called a payable, just like the entry you did in the last in part A, where you called it legal expense payable. Remember, so every time you do an adjusting entry, if it's the expenses incurred and you have not paid for it, you will create something called a liability. So you have created an interest payable in this case. So now your end of the month, your interest expense fully reflects all that interest related expense that you have accrued during that you have incurred during the month of April, right? So now May 20th, that's when you make the cash payment, right? So how are you gonna, then the question asks you, how are you gonna make this subsequent entry? So you have created this payable, right? You have to you have to get rid of this payable which you created on April 30th, and you have to pay that. So first of all, you know that this interest payable is going to be debited for 3,000, right? And you know cash is going to be credited for how much? For 9,000. It tells you you paid $9,000 every 20th of each month. And so what's the question is, what is now for the first 20 days of the month of May, right? From May 1st to May 20th, that is called an interest expense for the month of May. So you've matched the right expense in its right periods, which is $6,000, right, for the month of, for about 20 days. So that will be, and that entry will take care of both the end of the month, April, so end of April adjusting entry, and also the subsequent entry when you're gonna pay that payable, and also for the first 20 days of May interest expense. So the same thing you're gonna do end of May, which you just did here on April 30th for the first 10 days, and same June 20th. So this is how the adjusting entries are done every month. Okay.